The decennial pattern. The decennial pattern is a theory regarding the specific years of a decade having importance. In the chart below, I've mapped each decade from the 1950s onwards so we can see which years were the most profitable on the stock market. You can see here clearly the 1990s was a terrific decade for investors. Having gone from approximately 350 here at the start of the 1990s, so 1990, 91, 92, 93, etc. to 1999, you can see this huge surge here. So there, what a fantastic decade that was for the stock market. So to explain the chart here, we have the S&P 500 index points from 0 to 1,600 points, and each year here across the bottom indicates the first year of the decade. So this is the 0 year, for example, 2001, 2002, 2003, 4, etc. So what we're showing here is what years seem to be most important with each decade that we look at in the stock market. So if we look at the 1950s, it's hard to see this here, but you can see that year 0 was less of a gain than, for example, in year 9. And as we move up, let's take a closer look at the 1980s, for example. You can see the larger gains being in year 3. Definitely year 7 was a strong year, with a pullback in year 8 and a push in 1989. You can see, obviously, from the 1990s, the huge gains came in year 6, of course, 7, 8, and 9. Now, when we take a look at the year 2000s onwards, you can see here, of course, the recessions clearly reflected the dot-com bust here, reflected badly upon the market here and here, and we can see here the gain in the market here with year 7 being, so 2007 being probably the best year in the market, along with 6 and perhaps 5 as we recovered from the dot-com pullback. So I've mapped here an average, and you can see here really this dotted line across the middle here. You can see this is the average performance across the 60 years mapped here. And you can see, well, on average that the year 0 seemed to fare reasonably well, but the real gains clearly came in year 5, year 6, and year 7, with stabilizing out with year 8 and year 9 here. So what does this all tell us about the decennial pattern? Well, what it would seem like to me is the latter half of the decades seem to be good times to be investing. So if you're investing very long term, then you may well be advised to be looking at much longer term investments, let's say in ETFs or market tracking funds, towards the latter half of the decade, according to this performance. Of course, the 2008 to 2009, March 2009, wasn't very well performing at all. So I think it is dependent on which decade you're investing in. However, it seems in general here on the averages of the last 60 years that the latter part of the decade sees better performance.